44,000. That is the shockingly weak number of private sector jobs added just last month. It's a jarring figure, really, flashing some major warning signs for our economy, even as we're witnessing record highs on Wall Street. Hello, everyone. Welcome back to AI Market News. Today, we are analyzing a market of profound contradictions. The overarching theme for all of us here is the illusion of perfection in the U.S. stock market versus the cooling reality of our macroeconomic labor data. Usually, these two walk hand in hand, right? A booming stock market typically reflects a strong, expanding economy with robust hiring. But right now, they're telling us two entirely different stories. We have equity markets literally touching the sky, while our foundational jobs data is quickly pulling back toward the earth. Here are the top stories we're tracking for this explainer today. First, we'll examine the Dow's record run and the ongoing tech rotation. Second, we'll break down those labor market warning signs. Third, we'll look at the impact on the USD/JPY and the Nikkei 225. And finally, we'll preview Friday's critical jobs report. Segment 1. Dow record and tech rotation, a tale of two markets. Let's dive into the massive divergence happening right now in U.S. equities. As the graph shows, the Dow just secured its fifth consecutive record close, gaining 263 points to finish at 54,349. Based on available data, while the broader tech indices slipped, capital is actively seeking safety. We are seeing a distinct movement where money is being parked in established blue-chip names rather than riskier assets. Why is this happening? Well, in times of uncertainty, capital acts a lot like water flowing down a mountain. It aggressively seeks the path of least resistance and highest safety. Investors are currently locking in gains from the tech sector and moving their money into mature companies with predictable cash flows and dividends, effectively shielding portfolios from any impending economic turbulence. To understand why this is happening, we have to look at the underlying mechanics of the tech sector. According to current market information, the AI bubble is facing a serious reality check. The market had priced in absolute perfection for these companies. So when a bubble expects flawless execution and infinite growth, but suddenly meets the hard reality of massive infrastructure costs, the recalibration is swift. When a company like SpaceX reports heavy AI capital expenditures and less than perfect earnings, the market punishes them, resulting in a 7.3% drop. AMD also fell 4.5%. But the money leaving these tech giants doesn't just disappear into thin air. It rotates. Investors are moving our capital into defensive value plays like Disney, which rose 3.6%, and Eli Lilly, which rallied 5%. Segment 2. Labor market warning signs, cracks in the economic foundation. While the equity markets celebrate, the macroeconomic data paints a much more cautious picture for all of us. Before the official government reports drop, we look at two crucial early indicators, the ADP payrolls and the ISM Services PMI. Simply put, ADP measures private sector hiring, while ISM gauges employment health within the service industry. Why do these metrics matter so much for all of us? They are essentially the canary in the coal mine for our broader economy. The service sector makes up a massive portion of our economic output. So when these early indicators flash red, they give us essential clues about the broader health of the economy, which in turn heavily dictates potential Federal Reserve interest rate policy changes. The actual data released was a significant miss. ADP payrolls came in at a dismal 44,000, well below the consensus estimate of roughly 68,000 to 70,000, marking the lowest level we've seen since January. Furthermore, the ISM Employment Index dropped to 47.4, falling right back into contraction territory. We really have to emphasize the gap between the consensus and the actual result here. A miss of this magnitude shocks institutional investors because it suggests the slowdown is happening much faster than anyone predicted. The underlying mechanism here is simple. Businesses are slowing their hiring due to rising borrowing costs and economic uncertainty. This explains exactly why the broader market is beginning to aggressively price in a slowing U.S. economy. Segment 3. USD/JPY and Nikkei 225, the local market impact. Let's bring this analysis home for Japanese investors and see how this all connects. As the graph shows, here is the daily chart of the USD/JPY, dollar-yen, right next to the US 10-year Treasury yield chart. Currently, US 10-year yields are hovering around 4.63%. Why does this exact yield matter so much for all of us? Because the interest rate differentials, that critical gap between higher US rates and lower Japanese rates, are the primary engine driving the USD/JPY, dollar-yen. If US yields fall, because of that weak labor data we just discussed, the dollar weakens against the yen. A stronger yen makes Japanese goods more expensive abroad, which severely hurts the profit margins of global Japanese companies, heavily influencing and pulling down the export-heavy Nikkei. Segment 4, Friday's Critical Jobs Report, the main event. We are now looking ahead to the upcoming catalyst that will definitively determine the next major move for global markets. Let's review the economic calendar. On Thursday at 8:30 a.m. ET, we will see weekly jobless claims and Q2 productivity data. Thursday also brings a major technical event, the SpaceX lockup expiration, which will release 900 million shares onto the market and could definitely trigger further tech volatility. But the most vital piece of data arrives Friday at 8:30 a.m. ET with the July non-farm payrolls. Why is this Friday report so absolutely critical? Well, if that jobs number comes in below 50,000, we could see a sharp drop in yields and a significantly weaker dollar as market expectations for future rate hikes collapse entirely. Which leaves us with a critical question to consider. If rate expectations do collapse this Friday, are we simply looking at a minor healthy market correction, or is this the beginning of the end for the current bull cycle? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.